What's going on, team, and welcome back to another video. So today I want to talk to you about mitigation blocks as well as breaker blocks. A lot of people mix these concepts up, so I also want to explain the difference between the two. Before we jump in, I just want to let you know that there's concepts and then there's strategies. This is more so of a concept that will help you determine direction of market, and it's not necessarily a strategy that will help you find the exact entry point for that trade setup. This is why we use these concepts in conjunction with other technical analysis. For example, sweep of liquidity, market structure shifts, and more. Alrighty, so before I show you any live examples, I'm going to quickly break down these drawings which represent a mitigation block as well as a breaker block. So let's start off with the left example, which is a mitigation block. Just keep in mind that this is a bearish example and a bullish example is just opposite of what I'll be showing you here. So a bearish mitigation block is when price reaches up to a resistance level and rejects. And after that rejection off of resistance, what you want to look for in price is a failure swing high. And a failure swing high is when we fail to get above the high that we made at resistance, which creates a lower high. Once when you get that failure swing high, the next thing to look for is a market structure shift below a previous low. This confirms that the algorithm is now wanting to push price lower. A lot of new traders believe that this price leg down was a missed opportunity, but if you're experienced, you know that this is the time to be patient, because what you need to do is wait for price to come up and retest that swing low that was broken previously. The reason why this retest is so important is because people are mitigating their long positions from previously, and let me explain. So let's say, for example, I was an individual that took a long position at this swing low and had my take profit at this high and my stop loss at this low. What's happening is my trade is initially in a profit, then it goes break even, then I'm in a drawdown. The moment it comes back to being break even, I'm going to close my long position, or in other terms, mitigate my long position. And because myself and many others are closing their long position here, the algorithm is going to drive the price lower the moment we retest that level. The best spot to put your mitigation block would be on the last down close candle of this swing low here. And once the market retraces back into that last down close candle, the algorithm should expect lower. And again, this is because people are mitigating or closing their long positions from this swing low. So now that you understand the concept of a mitigation block, let's take a look at this example here, which represents a breaker block. Mitigation blocks and breaker blocks are very similar, but there's one major difference between the two. Instead of the market creating a failure swing high at resistance, a breaker block will actually sweep above the high that was created at resistance. Once when you get that break and sweep above the high, this is when a breaker block becomes very similar to a mitigation block, because what you'll look for next is that market structure shift below the swing low and wait for price to retrace back into it. Once when you get that retest at that swing low, you can expect market to continue lower. And again, this is because people are mitigating their long positions that were taken previously over here. Alrighty, so now I want to show you some real life examples of mitigation blocks and breaker blocks. This is an example of a bullish mitigation block because you can see the market comes down into support, bounces off of it, then creates that failure swing low here. And once when we got that failure swing low, you can see that we got our market structure shift next, which is when the market breaks above that swing high created here. And because this is a bullish example, you can see right after the market structure shift, we retested the last up close candle, then price continued to see higher. If it's a little bit difficult to see the bullish scenario, what you can do is always invert this chart, and you can see now that this example looks exactly like the drawing I showed you guys. Now let's show you a live example of a bearish breaker block. Like I showed you in the example before, you can see that the breaker block breaks and sweeps above the old high, then creates the market structure shift. Once when we got that market structure shift, you can see that the market respected the last down close candle and price continued to see lower. So that's the concept of mitigation blocks and breaker blocks. And if you have any further questions on this video, please reach out to us through our questions channel located in the Discord server.